It is Friday, August 21st, 2020. It is 8 p.m. Pacific Standard Time, and so you know what time it is. It's time for a little bit of coin metal. And it was yet another non-virtual get your ass kicked at Jiu-Jitsu Friday, and actually I did get my ass kicked at Jiu-Jitsu today. And we're doing some Berimbolo stuff today. And it's one of those things where, you know, it's like, I've been doing gi jiu-jitsu for about 3 years now, and the vast majority of the stuff that we covered did not include leg elements for the type of things that we were doing today. It's different. It's all different. I mean, I know that I've done something in the Berimbolo in gi jiu-jitsu, but like the grips are different, you know. So like when you're gripping on your opponent's ankle or something like that, you have not just their ankle to grab onto, but you also have their gi pants to grab onto, and that makes a bit of a difference when it comes to moving your opponent around and just keeping control of them, you know. And so yeah, it was very educational. But I'm going to need at least another year of doing Berimbolo before I'm going to start feeling confident in it. And I really shouldn't say that. I mean, I'm kind of downplaying my ability there. I did feel a marked improvement. So, you know, it's not like I'm like lost in the Sahara on this stuff, but I'm not easy with it. I'm not smooth with it yet. But I do expect that I can get there. But today at the end, we did a little bit of an interesting thing. It's similar to pass keep, only it was sweep pass keep or something like that. You know, trying to basically is pass keep your guard, and I did okay at it, but I don't know. I think that it's one of those things where when I was doing gi jiu-jitsu, more of the rolling and the one-on-one drills, including, you know, like pass keep and stuff like that. We did a lot more of that, and I don't know how to feel about that, honestly, because it's kind of a lazy thing for an instructor to just say, "Hey, all right, so we're going to do, you know, 60 minutes of 5-minute rounds." You know, it's not really appropriate, you know. But even so, I do feel like the positional sparring, you know, starting off from the position that we're working with and trying to orient ourselves specifically, at least with the starting point, I think was really, really helpful. And it's one of the few things that I think would translate well between the training I was doing over at the one place and the training where I'm working with the people that I'm working with now. That I think positional sparring would probably help just a teeny tiny with hammering that stuff home. But, you know, like I said, I can understand the lack of desire to do that, only because it takes away from instructional time. You know, it takes away from time where the instructor can sit there and walk you through the position, you know, and give you opportunities to get repetitions in. And so, you know, it's 6 of one, half a dozen of the other. It's just a different training style. I'm not going to say I feel like I'm out of shape, because I'll tell you, conditioning-wise, I feel like I'm actually a little bit stronger. And just in some things, like my grips, I know I've lost a little bit of strength on my grips, and if I were to do it now, every tendon in my fingers would hurt for about a week. But I know that it's just a product of not training as hard as I was, and you know, and doing as many rounds as I was. But I don't know. I'm still kind of recovering from some injuries. My energy flow is kind of disrupted with some back injury that I've got, where my back has been really, really tight in my hips and in my And recently, I think I told you guys about this last time, I was doing some forward rolls, and I just fucking face planted on the last one, and I don't think I heard a pop. I don't think I felt a pop, but I definitely feel a twinge in my back where I didn't feel one before. So I got to assume that the two events might be related. Anyway, hopefully in the not so distant future, I'm going to be working up to that. And I think that I'm on the cusp of getting in 4 classes a week. And that to me is like the real beginning point for, kind of saying that I'm back, is if getting back to the same intensity level and number of sessions per week that I was. That's a goal for right now. But I'm not quite there. I'm getting a little bit smoother. And it's funny, on the last part of it, I was with one gentleman, one training partner for the whole class, and he was a little bit lighter than me, but he was certainly faster, and I'm going to say it, more skilled than I am. I mean, it was the first time that I'd seen him in class, but it was obvious from the way that he was rolling and countering me that he's got a bit more experience in the 10th planet system than I do. But I learned a lot. I felt like I like that, honestly. I like when somebody does have a higher skill level on me, because they'll do things and they'll do them in like it worked once and then they'll do it again, and if it works the second time they'll do it again, and by the third time I finally figured out what to do to whether it's grab an ankle or just shift my hand position or my leg position or something like that to try and disrupt it. And I finally got to where I was passing his guard like once every third attempt or so. I don't know. I passed his guard more than that, but it wasn't even. He was passing my guard. He managed to sweep me twice. And so yeah, that's that. Gotta have people above you so you have something to aspire to. I really think that that's at least part of the problem with plateaus. That if you hit a plateau in your training, a lot of it is because you get used to the same training with the same people, and after a while you get kind of used to their little habits, and everybody has them. But you've got to try and keep yourself aware enough of what you're doing so that you can adjust. And although I didn't stay behind for any rounds afterward, and honestly I couldn't. By the time I got out of there, I had a headache from dehydration, so I was just like, okay, it's time to get out. But yeah, I did some hardcore fishing yesterday, and so that kind of threw off my energy level a little bit, and my sleep pattern. But anyway, yeah, all told, it was very educational, and I'm feeling the spots where I really do need to be working on things. Like one thing in guard retention is shifting over to an inversion or an inverted position. It's very, very important to be able to do that. And there are a lot of sweeps that are enabled by getting in an inverted position. I tend to treat it as a negative. Like if somebody is going inverted on me, I like to try and crush them. Like grab an ankle and pull down on it so that they're stuck in that inverted position. Or curl their hips further in to where they're pinned down on the diamond between their scapula and their neck. There's little things like that'll make it to where they can't actually complete the movement that they were trying to. And sometimes I have to back out of it because you work yourself right into a triangle that way. But so yeah, like I was saying before, I switched from a lighter partner to a heavier partner, and I'm okay with that, honestly, because the fact of the matter is my size and my weight and my build chances are if I do competition, I'm going to be going against people that are heavier than me, are more experienced than me, so on and so forth, and are just generally bigger. So, whatever. Got to learn to deal with it now, right? But I think he passed my guard a lot less, and I did do some interesting tricks with him in that I was paying a little more attention to what I was doing, and because I don't know, the other guy was so fast, I really didn't have time to think. I worked into a position where he almost had my back, but I managed to shifted to where my hips were out of the range of danger, and I think I managed to even sweep him around to where I was on top. And it's not an unusual thing for me. But after that, it was like I was switched to another partner, and that's fine. I think that the guy that I was initially with, the guy that he switched to train with, was a lot smaller and a lot faster too. And just like I'm going to be forced to go against heavier people, he's going to be forced to go against people that are his weight, if not just slightly heavier, but way faster than I am. So it's, in my mind at least, it's really appropriate to be pitting him against somebody who is smaller, faster, lighter, more experienced, going to really tax him on his technique. And that's what happened in the transition. So I think all told, it all worked out just fine. But yeah, I had a lot of fun, and it's going to take me at least another year before I feel fully comfortable with the Berimbolo stuff that we were doing today. At least another year. Anyway, let's go ahead and throw down with some music. And we're going to start with Body Count. But what song? It's always a challenge to pick a good one out. I think this one is important because I remember when the first time it came out, and I was slightly taken aback by it, but for the most part I enjoyed it back then too. And so here it is, Colors 2020 by Body Count, First Dance, here on Coin Metal. And that was Skindred with Alive. And so, as far as where we're going to go tonight, it's probably going to be all over the place. I couldn't actually find anything really unifying. It seemed like everything I was running into was like disinformation or something. Not actionable data. We'll just go with that. I found this thing by Zeus Capital, or somebody claiming to be Zeus Capital. When I looked it up, there was actually 3 different accounts that were like at Zeus Capital LLP, at Zeus Capital LLP2. So it's like, okay, what the fuck? Who are these people? And am I looking at the people? Or is it a duplicate account or some shit? I mean, that's just crypto for you, I guess. Oh, no, don't do that. There we go. Yeah, and so I found this thing. It's on Zeus-Capital.com/assets, the Chainlink Fraud Exposed. And I don't know that I actually want to get into it, because I was looking at some of the comments, and it seemed like there is some claims that these guys were fudsters or fraudsters or some other bullshit. And so, I'm a bit hesitant to get into it, just because I'm not, oh, wait a minute. It says an investigative report on why Chainlink is the crypto's wire card. I'm terribly tempted to get into this thing. But we'll at least do the intro here, the executive summary, and and maybe a little bit more. I'm hesitant to get into it because I don't like spreading other people's disinformation. And I try to keep mine to a minimum. But anyway, I got this thing. It's on Zeus-Capital.com. And like I said, we're at least going to cover the executive summary. We're going to see what they have to say here. And so, yeah, this is the Chainlink Fraud Exposed. an investigative report on why Chainlink is the crypto's wire card. And this is authored on July 2020, or in July 2020. And I guess it was July 15th, 2020. And who wrote this thing? Team composite, very inexperienced, on-chain activities declining. Oh, it's just giving us a little review there, but it doesn't give us an identification as to who wrote this damn thing. So, again, I'm a little hesitant only because it doesn't have direct attribution. But anyway, we'll get into it. Executive summary. Bullet point 1. There is abundant evidence of market manipulation with traits of classic pump and dump techniques, such as trading on inside information, front-running the general public, unsubstantiated claims of progress, artificial transactions to imitate adoption, bogus partnerships, announcements, and any other trick in the book to drive up the price prior to dumping Link onto innocent investors. Bullet point 2, Smart Contract, the company behind Chainlink, controls all aspects of the onboarding process of each aspiring node operator, acting as the sole gatekeeper to the ecosystem and compromising the legitimacy, decentralization, and independence of the network. Bullet point 3. The tokenomics model is broken, with an inherent conflict of interest between holders, clients, and the founding team with regards to the pricing of Link. A clash and a crash are imminent. Yeah. Let's see, what bullet point is that? Bullet point 5. Despite the project's colossal development budget, Chainlink still runs on Ethereum-based testnet, exposing users to gas price fluctuations, network congestion, financial losses, and beta version bugs. Core features like staking are unavailable. Chainlink is trying to avoid a commitment of its mainnet launch date at any cost. The two founders behind Chainlink are constantly selling Link from their vast reserves at the market, as well as a substantial discount from the current price to selected institutions over the counter, OTC, thus incentivizing purchasers to lock in profits by quickly selling it further, creating a downward spiral. Link's characteristics, such as lack of a decentralized ecosystem combined with recent decisions by the Securities and Exchange Commission, leave no doubt that Link will be classified as a security, putting the whole enterprise and the investors at risk of anything from dealing in unregistered securities to court orders for the disgorgement of proceeds. In absolute dissonance with the price action, the actual usage of Chainlink network is fading. The transfer and call function recalls have peaked in February 2020 and are currently down nearly 50% of the record levels. Chainlink's addressable market is expected to reach $300 million US dollars by the end of 2023, which is roughly 4% of Link's fully diluted market capitalization. Chainlink's flagship integrations are openly disclosing that they are using the network as a secondary data provider or taking advantage of the project's deep pockets. The Chainlink service offering is prohibitively expensive, and it makes no economic sense for companies to adopt Chainlink's Oracle solutions. MakerDAO, Uniswap, Compound, etc. are internally developing alternatives which will eventually render the promise of Link obsolete. The people behind the project are few, mostly remote part-time consultants focused on marketing and community building, and lack the professional experience to lead and manage a project with a market cap in excess of $2.75 billion out of a co-working space. The few software developers associated with the project are making frequent but cosmetic changes to the code, while executives who previously took the bait are either fleeing the project or trying to avoid association with it. 3 independent valuation methods suggest the token is massively overpriced, as its intrinsic value is estimated to be in the 5 cents to 20 cents US dollar range at best. As a result, Zeus Capital maintains a strong sell recommendation on Link with a target price of 7 cents. We believe that in the near to midterm, this will become another classical going down to zero fiasco. Disclaimer: by downloading this document, you explicitly agree to the terms of this disclaimer, including the risk of financial losses, fraud, and misrepresentation. In no event or form is Zeus Capital or its officers, members, representatives, authors, investigators, backers, supporters, advisors, clients, suppliers, or financial entities associated with them, henceforth collectively known as Zeus Capital, responsible for any direct or indirect trading or investment losses caused by any information contained within this document. And so, yeah, we're probably not going to get into the substantiation of their accusations. But we will look into the conclusions, which is on page 57 of this thing. Jesus Christ. So, yeah, let's go down to that 7. Well, I don't know. You know, a lot of this looks like it's presentation materials. So, I think we can read through it. I'm interested in it only because I read Link's white paper and I didn't really think it was going to work. So, I'm interested. Well, I mean, when I say not work, I mean that I didn't believe that it would eventually be some replacement for anything or provide any additional utility that you couldn't get out of a cryptocurrency. Anyway, yeah, let's get into this. Project overview. Chainlink would like to present itself as a valuable network of decentralized oracles aiming to bridge the gap between real-world data feeds and the needs of the ever-growing blockchain applications. Taking a deep dive, however, concludes that the project is yet another intermediary, ultimately converging to a centralized and prohibitively expensive service, targeting an extremely narrow market with little to no traction, and essentially relies on PR status and price manipulation to maintain an unreasonably high market cap in the hopes of financial gains for the founding team under the motto, "Fake it until you make it." That's a lot of crypto. I'm just going to say it. Understanding and evaluating Chainlink's value proposition, or lack of it, requires examining the problem that the company is trying to tackle, the size and the structure of the supply chain it operates in, and the project's competitive position in capturing the value it eventually creates. What problems is Chainlink aiming to serve? While some smart contracts rely solely on information available on the blockchain, the vast majority of these applications are triggered by externally generated and stored data feeds. If two parties are making a bet on a basketball game via a smart contract on a blockchain, a third party must let the smart contract know the outcome of the game by publishing the associated data on the blockchain. As a result, a core bottleneck for the widespread adoption of the technology is the inability of smart contracts to interact with any real-world data or other resources outside of the blockchain network. Financial derivatives are actionable once predefined market conditions are satisfied. Bond prices and payments are subject to prevailing interest rates, and insurance and gambling payouts are triggered by the outcome of real-world events.
These and many more applications could be automated through smart contracts as long as the external data is fed in a reliable, timely, and trustworthy manner. The Oracle problem. One proposed solution to the data bridging problem is via an oracle. An oracle, simply put, is a trusted person or entity that brings real-world data into the blockchain world. If two parties are making a bet on a baseball match via a smart contract on a blockchain, the third-party oracle lets the smart contract know the outcome of the game by publishing the associated data on the blockchain. The key problem of oracles is their incentive to take bribes from users or become users themselves and rig the outcome of the bet in their favor. Relying on malicious or incompetent oracles results in the outcome of a smart contract being compromised, rendering the whole smart contract concept pointless. For instance, a hacker might take control of an oracle and influence the payout of a smart contract. Or, if two parties bet on a sporting event, the loser might be able to simply bribe the oracle to report the wrong winner, which would result in the smart contract sending the funds to the losing bettor. Because the blockchain itself has no way of verifying the authenticity of the off-chain data provided to it by the oracle, this kind of fraud is possible. And while the winning bettor would certainly protest, blockchain transactions tend to be irreversible. The only thing the blockchain can do is compare answers from different oracles weighted by the amount of collateral each one provides or some alternative selection methodology. In other words, successfully cheating would require what effectively amounts to a 51% attack on the decentralized oracle network. Depending on the algorithm behind it, one should compromise just a few oracles, say 3 to 4, or stake 51% of the collateral to take control of the smart contract's outcome. So far, the operational oracle structures have different degrees of centralization, meaning they present a single point of failure. It is clear that oracle-based smart contracts will hardly be able to offer the level of security guarantees found in completely native crypto transactions, i.e. on-chain. So the question is, how secure can oracles get? Perhaps users will be okay with introducing a bit of counterparty risk into their spending wallets on a layer 2 payment system like the Lightning Network, but would they store the majority of their savings in a smart contract where the oracle is effectively a custodian of their funds? Knowing about the oracle shortfall, how much of your wealth are you willing to risk on an oracle system? Are you willing to stake your house or your entire business on it? How is Chainlink supposed to work? This presupposes that it does work, which is open to debate, and our conclusion is that it does not. But let's give them the benefit of the doubt for a moment. The project is a, quote, blockchain middleware, providing a protocol for a network of decentralized oracles, enabling smart contracts to securely access external data feeds like web APIs, real-world events, and payment networks. The goal of the project is to create an independent reporting structure that drives two main functions. Number one, it puts and verifies data from multiple independent sources, mitigating the risk of faulty reporting, data accuracy, and system failure. And number two, it acts as a translator by importing new raw data into a smart contract environment. How is this achieved? Upon request or a predefined trigger, the external data, ergo security prices, weather information, outcomes of sporting events, etc., is aggregated from multiple sources by numerous node operators. Based on an algorithm adapted for this particular case, the oracles form a consensus that is then returned to the smart contract. The Chainlink network is powered by the project's proprietary cryptocurrency Link, the sole purpose of which is to reward operations for the work performed and investors for the token staked, sometimes referred to as Mining 2.0. And here comes the first caveat. There is an inherent conflict of interest between token holders and the companies utilizing the Link token. The first group benefits from a higher price, whereas the second wants it to be lower as it is directly related to the user's operating expenses. We argue that the currency adds further friction to an already fragile ecosystem, rendering Link's existence pointless. The ecosystem is supposed to work as follows. Number 1, an end user requests an Oracle service by posting a job on a marketplace like market.link. The job description specifies the number of oracles needed, the minimum reputation of the oracles delivering the data, and the price in Link that the user is willing to pay for the retrievals. Number 2, Chainlink nodes then decide whether or not to bid on the proposal. The smart contract will only accept bids from nodes that meet the requirements outlined by the user. When an Oracle service provider bids for a job, it commits a certain amount of Link that will be forfeited via a penalty payment in case of misconduct. 3. Nodes that win the bidding process are entitled to run the job and be rewarded with Link upon successful completion of each iteration, namely each data retrieval. Node selection is based on a reputation system taking into account uptime, response time, track record, size of the penalty payment put as collateral, and the total amount of Link held by the node. And here comes the next catch. The weights of these factors are not publicly disclosed by Chainlink yet, raising red flags about the integrity of the process and the overall transparency of the project. Not to mention conflicting with the core values of blockchain technology, nodes that provide bad or inaccurate data are penalized by decreased reputation score and a loss of the collateral. By having skin in the game, operators are incentivized to run throughout the whole task. One byproduct of this arrangement is the decreased volatility of the Link in circulation. In theory, the proposal sounds appealing. There is yet another caveat, however. The staking mechanism is not working as of the time of this report. It is expected to become live with the launch of Chainlink's mainnet. The topic is widely discussed by the community. Chainlink's team, however, has not set any specific time frame for implementation of this feature. Since May 2019, Chainlink has been running on Ethereum, exposing the project of fluctuations in gas price and malfunctioning of Ethereum, as it happened during the last crypto market crash. Additionally, the loud proclaimed acquisition of the Town Crier, which aimed to boost the security of the network through Intel SGX, has not been implemented for nearly 2 years now. What about the Oracle problem? Does Chainlink adequately tackle it? The reputation system will most likely result in a handful of nodes performing the vast majority of the work, as they will have a strong competitive advantage against newcomers. Is this observed at the moment? Since August 2019, there has been an active marketplace for node operators and job postings. Currently, 74 approved node operators are offering 822 unique jobs. However, the top 16 nodes, or 20% of the total, or less than, roughly 20% of the total, are running pretty much all of the work in the network. Therefore, smart contract and link pool are in full control of the nodes operating on the network, as each edition undergoes a KYC/verification process. This result is a highly centralized network that could be compromised by the node selection process, the primary sources used, the consensus algorithm, and the Oracle operators themselves. Subsidies. In an attempt to stimulate adoption and achieve a dominant market position, Chainlink is granting hefty subsidies to the node operators participating in the network. The project has reserved 35% of the link outstanding, or 350 million tokens, the equivalent of almost $2.4 billion for nurturing the Chainlink community. Pouring money into the ecosystem to foster adoption and build a leading market position is standard procedure for most high-flying unicorns these days. However, one should carefully examine the discrepancy between subsidized and unsubsidized prices, the cost of replication, and the impact of the influx of new tokens on the supply/demand equilibrium when evaluating the long-term sustainability of the ecosystem and valuing the token itself. How does the process work right now? Suppose a project wants to implement Chainlink's solution. The team could either purchase Link on the open market or contact Smart Contract, the entity behind Chainlink, to get a quote for the service. The actual offer sent by Smart Contract quotes 5 cents US to 10 cents per node operator for each data request. At the same time, the price change per data request on the testnet is set in Link. By taking this information into consideration and examining the on-chain activities, it becomes evident that individual nodes are paid between Link 0.16 and 0.133 links per call, which is simply one link divided by the number of nodes participating in the request. Considering the staggering difference between the current price of a link and the smart contract's offer, a potential user will likely pay between 20 and 70 cents per request to the smart contract. On the other hand, the company behind Chainlink will be transferring Link 1 from the subsidy fund to the operating nodes each time a request is made, constantly inflating the tokens in circulation. Given that the current price of a link is $7.95, the discrepancy with the other results in a subsidy of more than $7 per data request. Taking into account the limited number of nodes performing actual work, the relatively low hardware requirements, and respective operating costs, the current model might result in fictitious work performed in an attempt to privatize the subsidy tokens. As outlined in the token allocation section, Link 15 million from the reserve have already been paid out, leaving Smart Contract with a balance of Link 335 million for node incentives. At a rate of 1 link per call, 229,522 data retrieval calls made in March 2020, month with relatively high activity, and 5% monthly growth in these requests implies that Chainlink's subsidy fund will last until August 2027. Given the price discrepancy between what smart contract is offering and the link levels on the secondary market, chances are the company behind Chainlink will be selling tokens in the foreseeable future, putting the whole project at risk for regulatory scrutiny. More on this later. From a user standpoint, the operational costs of replicating an oracle are mostly in the form of electricity expenses for running several average computers. In case of high utilization, the cost of this setup is way below the 30 cents to 70 cents per call the smart contract users are charged. Let's see, operational cost of replicating the Chainlink network. Power consumption of a node in watts per hour. Watts per hour is 120. Number of nodes is absolute at 7, and price of electricity is 5.5 cents per kilowatt hour. Operating cost of running this setup for 24 hours is $1 and almost 11 cents. Wait, is that a comma? No. Okay. We need 7 average computers consuming 120 watts per hour each hour. An electricity cost of 5 cents per kilowatt hour, which is an approximate average for Bitcoin miners. Based on the assumptions, the cost of replicating the Chainlink network is $1.11 per day. The bottom line, Chainlink is attempting to tailgate and capitalize on the fad surrounding smart contracts' inability to interact with resources outside of the blockchain. On top of being far from fully functional with vital features not expected to be delivered anytime soon, the underlying architecture of the project fails to address key issues like security, alignment of participants' incentives, and the timeliness of information delivery. We argue that the Chainlink network is yet another unnecessary intermediary, the purpose of which is to promote and support the link, a pointless utility token whose only use case at the moment is speculative trading and enrichment of a certain group of people, namely the founding team. And you know what? We're going to pause it right there. And we're on page 11 already. So I think we might actually be able to get through all of this tonight. And I'll just say it up front. So far, in my mind at least, the methodologies being used here as far as the way that they're coming to their conclusions, they seem relatively reasonable to me. Now again, I'm just going to state that I don't use Link. I'm not a node on Chainlink. I'm not involved in any way, shape, or form. I tend to stay away from ERC20 tokens, but that's just me. I don't believe that the ICO funding model is really appropriate for crypto projects because it's kind of like giving you the cheese before running the maze kind of thing. And that in itself, I believe, kind of makes them a little more susceptible to time and money wasters, such as these guys are saying that Chainlink may in fact be. But like I said, we'll get back into this on the other side of the music break. But yeah, we're on page 11, and this is on Zeus-Capital.com/assets/the Chainlink Fraud Exposed.pdf. Anyway, yeah, like I said, let's get back into some music. And as far as where to go, I don't think I played any Slipknot. So let's go with that. The Blister Exists, here on Coin Metal. And that was An Uncertain Future by Nevermore. And so, let's go ahead and get back into this thing. I think they're giving us a relatively honest report. And so I don't feel like I'm really spreading any unfounded FUD, because their methodologies seem sound, at least to me. Alright, let's continue. So tokenomics, we're on page 11, and this says Zeus-Capital.com/assets/the Chainlink Fraud Exposed. Examining the long-term supply/demand incentives shows that Link will exhibit an extremely high velocity combined with an excessive number of tokens in active circulation. New nodes will be constantly looking for alternative platforms as Chainlink's network becomes exclusive to a limited number of operators. The main driver of exclusivity is a reputation system that discriminates against newcomers. The open source nature of Chainlink is driving down the technical entry barrier, giving aspiring networks of decentralized oracles an excellent base on which to build. End users will be shopping around for the most competitive price as the service is commoditized. The result will be end users being reluctant to hold substantial amounts of Link as a hedging instrument against adverse price movements. Chainlink's existing competitive advantages against alternative networks are limited to treasury reserves that are highly dependent on the price of the token, and a large community is turning hostile as time progresses. Combining these factors should result in an influx of free-floating Link and a game of hot potato between users and nodes, with founders, investors, and speculators adding further stress to an already fragile market. The Link token has two core functionalities. Number one, provides access to the infrastructure by being the only acceptable payment method in the ecosystem. Number two, acts as a form of issuance derived from the penalty payment in case the agreement outlined in the smart contract is compromised. Both features come at the expense of exposure to Link price fluctuation and service price premium, compensating stakers and node operators for the cost of their capital, work performed, and reputation built. Focusing on the long-term steady state, demand is meant to be driven by end customers who are sourcing tokens to pay for their operational expenses. Supply, on the other hand, is provided by node operators who accumulate tokens as a compensation for the work performed and reputation built, and stakers who convert their network rewards into other asset classes. The inherent conflict derives from users' interest in Links being cheaper than other currencies, while node operators and investors benefit from Link's appreciation against other assets. The price in the long term will converge towards an equilibrium based on supply and demand of these groups. The following examines the incentives of each major group involved in the Chainlink ecosystem. Chainlink's decentralized network services are an operating expense for companies and projects that are running blockchain applications. Most, if not all, of these projects will have a different operating currency to Link, so the exposure to fluctuations in price of Link will be considered as an additional business risk. A natural reaction would be to seek a way to hedge that risk, which could be achieved by either locking the price in advance via the purchase of sufficient amounts of Link, or financial instruments like futures and options, which are currently quite limited for Link trading pairs. As a result of this price uncertainty, everything else is being equal, the cost of Chainlink network should be lower than that of an identical network that conducts transactions in a widely accepted asset like stablecoins or Bitcoin or Ethereum. The commoditized nature of Chainlink's service suggests that the end user's purchase decision will be driven solely by the most attractive price offered on the market. This will lead to competition between node operators and eventually to the emergence of competing networks. Chainlink and its equivalents for the limited amount of work available. Assuming there are multiple platforms like Chainlink offering the same services with negligible switching costs, the end users will be reluctant to hold large amounts of Link. The result is an increased volatility of the token, or velocity of the token, which will lead to depressed prices on the secondary market. Not necessarily. There's also the overall market sentiment, and speculators, they tend to create as much movement as they're responding to. So yeah, anyway, continuing on. Expanding on the expected velocity of the token, according to one of the project's developers, the token's state, either held by the node or posted as insurance for penalty payments, have diminishing returns in the node selection process. Having link on a node helps get the node started, but there is a point of diminishing returns for how much link to hold. Nodes that simply have enough reputation may be eligible for this job. From that, the node selection will be random. Combining the bounded number of node operators as a result of the reputation system with diminishing returns of these staked tokens will lead to a relatively flat number of link put out of circulation as a result of staking or collateralization. Moreover, the link accumulated as part of the node's operational activities will most likely be dumped on the secondary market as the diversification attempt from overexposure to the ecosystem and in order to finance operating expenses, which are presumably denoted in government-issued currencies. Adding to the sell-side pressure, some of the passive stakers might offload their network reward for similar purposes, purchasing other assets. Last but not least, as outlined in the token allocation subsection, smart contract and the founding team will play a major role in the supply side as they control a staggering amount of link. The implications of the baked-in token economics mean that buyers won't hold large amounts of link because they will constantly look for cheaper and more predictable alternatives. Meanwhile, sellers will hold relatively constant amounts of link to support their reputation score while pouring the excesses onto the secondary market. The architecture of the reputation system will result in node operations having a negotiation power over the passive investors, as there will be a limited number of highly rated nodes and an influx of link holders looking to enhance the yield on their investment. The result? Link's velocity will be extremely high, because there is no strong incentive for either party to hold on to it. At the same time, the staked amounts will stay relatively constant and will have a negligible yield, as the transaction fees will mostly be captured by the node operators with the highest reputation score. Finally, there is no deflationary mechanism in place to reduce the flood of tokens from founders, subsidies, and speculators. Token allocation. Following the 2017 ICO, 65% of the tokens, or link, 650 million, left with the founding team, while the rest are shuffling between investors and speculators. Token sale terms. The crowd sale is capped at $32 million. The total supply of 1 billion link to be distributed. 35% is going to node operators to incentivize the ecosystem. 35% will be sold in public token sales. 30% will go to the company for continued development. Ethereum ERC20 token directly purchasable with ETH. 2 years and a half after their ICO, the distribution is still highly concentrated, with the largest holdings persistently held by the team behind the project. Let's see here. And it gives us a list of addresses in all of the link held. There's like 350 million of them in one smart contract. Or that's the owner's smart contracts. Wow. Out of the top 10 addresses, the founders control 62% of the tokens outstanding, or whooping link 620 million out of 1 billion, almost 4.8 billion US dollars. Tracking down the path of the missing 30 million from their the initial allocation, it becomes apparent that some of them have been transferred to secondary addresses to finally arrive at an operational one paying subsidies to nodes. Step 1 to the 21th power is greater than 2 to the 22nd power is greater than 3 to the 23rd power. Subsidizing wallet, node operator. Oh no, those are arrows instead of greater thans. Others, however, have been dumped on the market following fake or grossly overstated project updates. What is the split between the two? It is hard to track down all the transfers due to the number of intermediary addresses and transactions involved in the process. There have been roughly 2 million transfer and call requests since the inception of the network. Assuming that all of these transactions have been facilitated by smart contract and that the price of a call to the end customer is 50 cents, the company behind Chainlink would have pocketed nearly $1 million without touching the secondary market. Considering the enormous outstanding balance for subsidies, initially $350 million, for Link, and now presumably in excess of $348 million, and the price dumping made by smart contract, as we said, clients are charged 5 to 10 cents per node retrieval, while the current market price of Link is 20 cents. Oh, I'm sorry. The current price of Link, 0.2 Link, is about $1.59. Chances are smart contract will be the sole operational use provider of Link for a very, very long time. No, I disagree there. Continue. The scheme resembles the sale of XRP by Ripple, where the company has maintained continuous fundraising mode since its establishment. Apart from the constant pressure on the supply side as a result of the continuous increase in Link in circulation, a risk to this model is that sooner than later, regulators will take a closer look at these activities, classifying Link as a security. Unlike Ripple, smart contract is not locking the tokens in an escrow account with predefined release schedules. The company behind Chainlink could not be less transparent in their Link purchasing and divestment activities, making us believe they are in full control of the spot price action, bidding up the Link price during periods of weakness, selling upon spikes, mostly caused by PR stunts or outright lies covered later in the report. A byproduct of the model is that the secondary model is fully controlled by speculators and smart contract, or at least until the moment node operators accumulate sufficient amounts of Link and decide to divest their holdings. Hence, as network operational activities intensify, there will be more and more Link in circulation, putting downward pressure on price. When will that happen? Node operators are not wasting time and quickly transfer their rewards to Binance. From the Link 30 million that left the founders' addresses, 2 million Link at most have been paid to node operators. Where are the missing 28 million Link? They are at Binance and other exchanges. Through a series of transactions, I guess these are like references. It gives us 1, 2, 3, 4 Binance. Smart contract has been quietly shifting Link in small batches to trading venues. These activities have intensified over the past month, as one of the smart contract's primary addresses has sent a staggering number of 4.5 million Link. At an average price of $4 per Link, smart contract may have pocketed more than $100 million from selling redundant tokens to an unsophisticated investor base. After examining the top 11 to 30 addresses by the number of Link, the idea that most of the tokens are held by investors or that at least one received tokens during the ICO distribution or exchanges holds true. Looking at the next 20 addresses by size, a strange pattern emerges. Most of them are funded between 18 months to 1 year ago, with a series of transactions involving jump addresses and originating from Binance. Going back to smart contracts addresses and activities, the transfers coincide with the withdrawal of 12.6 million Link from one of the founders' addresses. The whole thing looks like a clumsy attempt to diversify the concentration of Link to more accounts that are yet again controlled by the team behind the project. Adding these to the total smart contract might control over 70% of the Link outstanding. Taking a more granular look, the distribution of investors holding period suggests the vast majority are short-term speculators, riding the uptrend rather than true believers, betting on Chainlink's long-term place in the blockchain ecosystem. The behavior of the token holders implies they are not loyal to the core idea nor believing in the bright future of the project. Instead, they are trying to make quick money. By speculating on an asset they do not understand, taking uncalculated risks, albeit quite profitably so far. Yeah, of course it's profitable when you don't have to pay as much for it as the rest of the market, and you're basically probably getting front-running information from Link directly as one of their proxies. Continuing on. Moreover, as a result of the rapid price appreciation, 92% of the token holders have bought the Link below the current levels. The Disposition Bias, a cornerstone in the field of behavior finance, states that investors are more willing to sell their winners and hang on to their losers. As the vast majority of Link holders are speculators, and virtually all of them have money on their bets, chances are that we are about to experience an episode of panic sale and free fall in the Link price once the community sentiment starts to cool down. Most tokens are either vested or held by the founding team or kept by retail and institutional investors. The common ground between these groups is that they have no interest in Chainlink's operational activities. Instead, they are looking for a way to realize their capital gains. Considering the lack of liquidity or any demand from actual network users, remember they can buy Link directly from smart contract for a fraction of the current price. Even a modest divestment by either a large investor or the founding team could have a devastating effect on the current market price. Analyzing recent on-chain activities and the behavior of smart contract addresses, we believe the house of cards will collapse soon. The project is quite active on Twitter and YouTube, mainly with PR stunts around partnerships with discontinued projects and theoretical use case presentations that are never implemented. Its Telegram community has also grown in the number of members. According to Into the Block data, the Telegram sentiment has been generally neutral as the community growth flattens. Twitter activities have been relatively flat, fueled by messages like this tweet if you've been in the Link for over a year or longer now. On Alexa, the popularity of Chainlink's landing page has been flat as well. The same is true for Google Trends. Scratching beneath the surface, the crypto community is turning hostile as new competitors enter the arena, while Chainlink is failing to convince the large projects to implement their solution. In fact, most of the paying customers resemble a pay-to-play scheme where smart contract stores large amounts for money in exchange for association with CeFi and DeFi projects. An example of this sentiment is prolonged discussion on Reddit, echoing some of the shortfalls of the project has, and labeling CoinLink the most overvalued cryptocurrency the world has ever seen. On-chain activities. A good proxy of the absolute number of jobs executed on the Chainlink network over time can be made by using a unique technical feature of the project. Link is an Ethereum-based ERC-677 token that functions like an ERC-20 with the added transferring call function, which enables token transfers and contract execution in a single transaction. As such, the usability statistics of the function gives a clear view of the number of jobs run for a given period. The number of calls on the transferring call function has been growing exponentially since the summer of 2019. However, the trend recently reversed. February 2020 was the first time since inception that there has been a decreasing number of transferring call requests. Moreover, contrary to the loud press releases and extreme volatility across crypto markets, Chainlink's operational activities stalled in March 2020, suggesting that the network is reaching its capacity. In April, however, the actual operational work performed on the network plummeted, proving that Chainlink's impressive market capitalization is the sole result of pure speculation and unrelated to the actual state of the project. And you know what, dude? You're going to find that throughout crypto. I mean, sentiment does count for something. Preference does count for something. Bias does count for something. You don't like it, but it's true. Continuing on. Bottom line, Chainlink's tokenomics is broken even before being implemented, as architects have failed to adequately incentivize stakeholders to keep Link in their wallets. The resulting ecosystem will be fragile, with tokens quickly changing hands between node operators, investors, speculators, and network users, putting enormous pressure on Link's price. Until a robust demand from actual users emerges, which we genuinely doubt, the token will be held by weak hands trying to time the market. The ever-growing Link supply combined with declining operational activities is a perfect recipe for a market crash. Realizing the uprising discrepancy between price and strength of the Chainlink network, insiders have the uncanny propensity to quietly flood the market with garbage. Link transfers from smart contract-related addresses to trading venues have intensified over the past few months. It is a matter of when, not if, the investing public become aware of Link's absurd utility proposition, or the token being classified as a security, diverting the project into debacle. Macroeconomics. And you know what? I think we can taste just a little bit more of this. We're on page 19 out of 50 something, so I don't know that we're going to get too much further into this. But yeah, we'll continue on. It seems like they're hammering on some good stuff here. In theory, Chainlink's addressable market consists of all private and public blockchain applications requiring off-chain data to become fully functional. According to research, the total smart contract market is expected to reach barely $300 million by the end of 2023. You're obviously not taking into account fiat inflation, dude. We've printed up $25 trillion over the last quarter. Compare that to the present market cap of Chainlink, which is roughly 10 times larger, and look for no other argument as to why the Link token is massively overvalued. In practice, Chainlink's only viable users are price-insensitive applications requiring secure data retrieval from multiple sources, namely the centralized and decentralized finance blockchain projects. Despite the generous subsidies, lack of strong competition, and apparent candidates for integration, Chainlink is failing to convince the leading projects to implement its solution. The only actual use case of Chainlink's oracles is to aggregate the price feed of crypto assets from various sources. As time elapses, our thesis that multiple vendors will be offering such a service for a fraction of Chainlink's price, or even for less, will inevitably come true. Addressable market. In theory, Chainlink's decentralized Oracle network might find application in a variety of areas, such as finance, payments, insurance, supply chain, utilities, government, and regulation, as well as gambling. In fact, Chainlink has outlined 44 ways to utilize their solution. However, considering the drawbacks discussed so far, the most natural use cases would be high-value smart contracts, projects relying on multiple primary data sources, or contracts/projects requiring a high level of security. Taking into account the infant development stage of the blockchain ecosystem, by far, the most intuitive applications of Chainlink's protocols are in the financial service space. Decentralized finance as a primary potential market. The universe of decentralized financial apps consists of lending projects, decentralized exchanges, derivatives platforms, payment applications, and assets such as WBTC, which aims to bring Bitcoin's liquidity to the DeFi market. However, looking at the distribution of the total locked TVL, total value locked TVL, it is evident that the leading platforms hold the lion's share of the assets. Such dominance is justified given lending apps are the foundational basis of the DeFi space, with pioneering projects such as Maker and Compound. A look at the top 20 DeFi projects by value, locked as collateral, clearly shows a concentration with a few projects holding the majority of the assets, especially MakerDAO and Compound, which together constitute approximately 58% of the whole DeFi market space. Other dominant projects include Flexa, circa 88% of the TVL in payments, and Synthetics, 97% of the TVL in derivatives. Such a concentration of locked assets speaks of scarce availability for potential users of Chainlink. Taking a closer look at the lenders, last year the DeFi protocols like MakerDAO and Compound, with private lenders like Genesis and Nexo, showed dynamic growth. According to a report by Credmark, the cumulative value of loans originated grew by 700% between 2018 and 2019. However, the portfolios of private lenders grew much faster than DeFi and remain the stronger in terms of AUM, and that's, I guess, active collateral in US dollars. The increase, the source for that was Credmark. The increase was fueled by new players entering the market, new product launches, as well as increased levels of institutional lending. However, corporate users clearly demonstrated their preference for centralized lenders, which drove their loan-to-value (LTV) ratio up from approximately 30% in Q1 to 63% in Q4. At the same time, DeFi levels remain much lower, although two types of lenders had the same TVL ratios at the beginning of the year. Whale's reluctance to do business with DeFi projects is natural. The lack of legal entity behind the contract, customer support flexibility when negotiating terms, security shortfalls, and variations in interest rates are just a few of the risks institutional investors are taking into account. The recent market turmoil and, and price drops have exposed the weaknesses of fully autonomous organizations. Both private lenders and DeFi platforms offer collateralized loans and liquidate positions when the value of the collateral drops below certain levels. However, while private lenders are able to intervene in the liquidation process with tailor-made offerings and flexible arrangements with their clients, DeFi relies entirely on automated liquidation mechanisms. Thus, in the case of negative price movements, DeFi platforms end up liquidating significant amount of collaterals, which in turn lead to further price drops. In the most recent crash, we have seen the total value locked, TVL, in the DeFi protocols dropping from $0.9 billion prior to Black Thursday to $0.6 billion the day after. Taking the March 13, 2020 sell-off as a case study, the majority of the liquidations happened on the decentralized lending platform Maker, due to a fault in the price oracles. Maker's liquidation mechanism malfunctioned and led to free liquidations at zero cost, amounting to $8.325 million, meaning that liquidated users lost all of their collateral instead of at most 13% of it, as Maker promises in its terms and conditions. The situation with Compound, another leader in the DeFi lending space in terms of value locked, was no different. It saw historically high value of liquidations even prior to the crash on the 8th of March, when the price of Ethereum dropped from above $250 per Ethereum to around $200, resulting in $2.5 million worth of liquidated collateral. When the price of Ethereum dropped by 30% on Black Thursday, however, Compound experienced its record for collateral liquidation, amounting to $4.19 million in Ethereum and 120,000 of USDC in about 24 hours. And we can go a little further. Despite the DeFi platform's attempt to blame these sell-off on technological malfunctions, there is an inherent conflict of interest between DeFi users and the platforms when it comes to liquidations. Generally, DeFi platforms charge lower interest rates, although they tend to fluctuate. Given the low interest rates, DeFi platforms need another source of profit, namely liquidations. When the borrower's loan is liquidated on the top of the interest rate, DeFi lenders charge penalty fees. Ergo, Maker charges up to 13% of the collateral value. The aim of these fees is to motivate the so-called liquidators who repay the loans on behalf of liquidated borrowers and earn some return while keeping the DeFi platform solvent. This means that liquidations are an essential part of the decentralized lending business model. The rapid sell-off around March 12, 2020 demonstrated major weaknesses in DeFi and the ecosystem's ability to handle significant market disturbances. It has brought uncertainty among users and investors and whether decentralized finance is ready to be a mainstream service. As Tushkar Jain, the partner at crypto and blockchain-centric investment fund Multicoin Capital, puts it, quote, "If we just all need to accept that crypto can drop by 60% plus in a day, that severely limits the usefulness of the tech." Why do we cover DeFi in such detail? Because this is the only viable option for Chainlink integration at the moment. As we shall shortly see, the vast majority of Chainlink's users are indeed DeFi platforms, and if the industry is doomed, so is Chainlink. Going back to the total addressable market, here's how the DeFi projects can benefit from Chainlink's oracles. exchanges, Uniswap, IDEX, looping, use cases, price feeds for DEX, access to off-chain accounts for confirming assets availability. Remittances projects, the project RippleNet, real-time data feeds on currency exchange rates. That's very key for Ripple. Type payments and e-wallets. The project Swipe, Omisco, and Edo. Validation of, in the use case would be validation of available funds with traditional players linked to various digital ledgers. That's I got to worry about that one with Omisco hosting tethers now. Continuing on, the type lending platforms, MakerDAO, RCN, Nexo, and Aave. Decentralized price feeds as a trigger for liquidations or payments. Oh, great. And so we can cause their fuck-ups to infect more of the market. That's fucking wonderful. Let's see. And for tokenized assets, stablecoins, Paxos... tokenized assets, Paxos, price feeds of physical asset that is tokenized. Yeah, you can't do that. You would end up having to trust the Oracle to give you an accurate feed of what the physical asset is worth in real time. And so again, any kind of manipulation as far as the providers of data or the validators, you're just factoring in a place for them to manipulate the market on gold or silver or some other physical asset. Continuing on. The next one is stablecoins, USD coin, True USD. Let's see, it would be decentralized price feeds. Oh yeah, so the Federal Reserve can manipulate the value of Federal Reserve notes in real time. The next one, investment platforms. Those that would benefit would be Swissborg, Molecular Future, and Digix DAO. Asset under management calculations based on real-time price feeds. Again, these price feeds can be manipulated. We've already this paper itself has already talked about a variety of ways in which the network itself could be providing false leads. Especially if they're incentivized to, i.e., bribed. But yeah, so to me, this whole thing, this paper just indicates that Chainlink's sole function is to reintroduce the risk introduced by a third-party arbiter. Only they want to do it on a grand scale. They want to be oracles telling everybody what the truth is, while they themselves can be corrupted on multiple points to distort what the truth is, or at least what the recognized truth is. And, no amount of regulation by a federal entity or a global entity, it's just like the UN or something like that. Yeah, no hope. No hope of regulating that shit. But as far as I can see, there's no way to guarantee that they're telling you the truth, and there's potential here for the price feeds or the price information that they're distributing to the market to infect legacy markets as well as crypto markets. So yeah, for those reasons I would stay away from it, but that's just me. Anyway, let's go ahead and throw back down with some music, because I think we've covered enough of it. We got about halfway through that paper. If you want to find that, again, it's on Zeus-Capital.com, assets /the Chainlink Fraud Exposed. But yeah, let's go ahead and go back into music. As far as where to go with that, we haven't played Judas Priest in a while. And all this talk of oracles and stuff, it always reminds me of this one song of theirs that I really, 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 really like. And so we're going to play it here in just a moment. When I find it, here it is. Judas Priest, Electric Eye, here on Coin Metal. And that was Killing Joke with Implant. And it is with that that I'd like to close out this episode. Thank you very much for listening. I certainly do appreciate the support. We will be back again on Monday at 8 p.m. Pacific Standard Time. And so until then, I want y'all to trade safe. Do your homework. And watch out for your own bunghole, because nobody else is going to do it for you. And so as far as our last dance is concerned, I've been dying to play some fucking Iron Maiden, and we just hadn't had an opportunity to do it before. So I think we should do that now with our last dance. And so I think The Trooper would be a good one for us to end out on. So that'll be it. Last Dance by Iron Maiden, The Trooper, here on Coin Metal. Thank you again for listening, and y'all have an excellent weekend. Good night.